Hello and welcome to another episode of NSE FINWIZ powered by CNBC TV 18. Today we're in the office of a company that's doing a great job in green energy, and it is our endeavor to make the personal finances of their employees a little greener. We're in the office of Welspun Energy in Noida. Welspun Energy is a part of the Welspun Group, which is one of India's fastest growing corporations. With a focus on green technologies, Welspun Energy is interweaving inclusive growth, social, economic and environmental sustenance in their projects to provide sustainable energy for all by the year 2030 through solar and wind energy. Focusing on our theme for the series, NSE FINWIZ visited Welspun Energy to gauge thoughts and notions of young professionals of the organization to understand their approach towards investments and financial planning.
There is no dedicated personal advisor as such, but there are brokers and there are dealers with whom I interact while share trading, and I also have relationship manager at a brokerage house, so I take advice from them. I get their internal research reports on various companies which they advise, and then I internally discuss it with my family and friends, and then I decide whether to invest or not.
Actually, I started working few months back, so I have not saved much money to invest it in somewhere. But yeah, I have started investing. I have invested in LIC and in PPF fund, and if I start saving some money, yeah, I would definitely look forward to save some money, to invest some money in, say, some commodity or in some property.
Yes, for me investment is foreign exchange. For me investment is going out of the way and buying certain shares and stocks. For me investment is hiring a trader for myself and asking him or her to invest for me and make money. That is what investment is for me.
With a raring-to-go attitude, these budding professionals of Welspun Energy were enthusiastically looking forward to the forum with our financial experts to take in the advice and pose their queries on smart financial planning.
Yes, I would like to seek professional advice because, that does mean something, especially if I'm venturing into a newer area. Then yes, professional advice would matter to me.
My first question would be, how do you decide as to which sector or to which investment is gonna make profit in a short duration of a time, one, and second would be, how do you decide that it is going to make it is going to be a profitable business in the long term. Probably it might be that in short term I might not get a return, but there are certain investments where in long term, yes, I get a huge chunk of return. So how is it, what is the rationale behind that decision, and how do we decide, how does that trend go? That is what I would like to know.
If I meet a professional expert or a forum of professional expert, then I would like to know that how the share market works, then what are the companies and how the stock markets go up and down, and where should I invest and why should I invest, and what are the returns that I would be getting back in how much time.
Well, we're now at the Welspun Energy office in Noida, and I'm joined by two very special experts. First up, on my left is Mr. Harshvardhan Rungta, who's a certified financial planner at Rungta Securities. And we also have Mr. Firoz Aziz, who's a director at Anand Rathi Private Wealth. Gentlemen, welcome. Thank you so much for being here. Firoz, my first question to you. Before we start talking investing and financial planning, tell me a little bit about the basic mistakes, the common pitfalls that people make usually when getting into investing.
Yeah, when you speak about pitfalls and ground rules, there is quite a few ground rules which need to be taken care of before you start investing. Predominantly, I would like to abbreviate those ground rules so that you can remember them, because as human beings, we tend to remember only 1% of what we hear. So I'll abbreviate it for you. I call it the smart way of investing. So I'll tell you what each alphabet stands for very briefly. Segregate your investments and your other insurance needs. This is the most common mistake when people start investing. So that's called segregating them. If you segregate those investments, you will almost end up saving your first year's premium in the first 5 years of you paying. So segregate your investments. Don't try to meet two objectives with 1 rupee invested. That's the most important thing. The second thing, which is M stands for measuring your risks. People are so focused on return that they don't forget measuring risks. Because return is going to be dependent on external factor. Risk is the only variable which you can choose to take, right? The return is going to be market dependent. The third point, which is called asset allocation, right? The A stands for asset allocation. People end up spending maximum time on seeing what security to buy, which stock to buy, which mutual fund to buy. Forgetting that asset allocation, which asset to buy, how much, that's very important, because that will dictate 90% of your returns in the future, not what you buy, how much asset of which quantity you buy. Then R stands for, again a very important thing, when people try to do their financial planning, they end up confusing between responsibilities and goals. If you ask him, what do you want to save for an individual? He says, I want to save for my kids' education, for my first home. All those are responsibilities, not your goals. Responsibilities are a subset of goals. Goals have to be more dream-oriented. And the last bit, which is T. T stands for tax efficiency. Like we've always heard, there's no free lunch. This is the only free lunch, tax efficiency. You can't miss this one.
Harsh, what are your views on this? What is your take on the common pitfalls?
Well, since we've already, he's taken the technical aspects of the investments, I'd like to take a little bit on the behavioral part of your aspects when you start investing. Since it's a very young crowd, you'll be very keen to know how do you get started, what are the things that you should be very careful about. So let me take on the behavioral part. The first thing that I would advise is that you need to be really wary about a one-size-fits-all syndrome. We're talking about personal finance. Remember, the word is personal finance. Very often we've seen that people in your age group tend to fall to this system. My friend has bought a particular product, my relatives have bought a particular thing, my colleagues have bought this, so it must be good and I should buy it. So we've commonly heard one particular policy, my friend has invested in this policy, all of us go and buy the similar policy. So when we talk about personal finance, each person has a unique set of requirements to himself. Their circumstances are different for each individual. You need to make sure that you do not fall to this one-size-fits-all syndrome. That's the first thing. The second thing is you need to set a goal. We've spoken about the responsibilities and goals, so I do not want to go much into the details, but I'm only going to try and give you an example. You leave your house to go somewhere and you leave your house to come to office. There is a difference. You need to foresee, you need to identify what do you want to do out of the savings that you're, the investments that you're going to make. So there has to be a set of goals. You need to really and clearly know what are you going to save for. It could be as simple as a wealth creation. I'm not saying you need to have something specifically for a particular cause, but there has to be some goal and some timeline to it.
Firoz, these guys are young professionals. They are just newly started investing. Some might have just started, or some have been investing for a few years. Why should they invest now? Why can't these are the heydays? Why can't we just go out, party, watch a lot of movies, travel a lot, and investing? Fine, I'll do it when I reach 40 or later on. Why now?
Very valid question. Everybody actually tries to defer their investment plan and their personal finance, like Harsh rightly mentioned, that goal setting is very critical, and doing it sooner is so important. Let me take an example maybe to tell you what is the impact of starting early. Okay, not even getting to 40s. If you defer your investment by 5 years, what is going to happen to your maturity value? Let's assume 10,000 rupees per month if somebody invests on a monthly basis for the next 25 years. His 10,000 rupees, if it's grown at the rate of 13%, will become 2.2 crores. But if he said, instead of starting 5 years later, I'll start today and have 30 years to invest, the 2.2 crores will become 4.5 crores. By deferring it for 5 years, you have reduced your maturity value by half. So every year you are actually losing out on substantial portions of your maturity value. So starting early, not 40 is really late. I would say the day you start working, you should start saving. I know, of course, you would want to spend the money because you've been waiting to start earning. But yeah, it's very difficult. I know it's easier said than done, but I think you should try and do that. So that's a large impact on maturity value. You can't let go of it.
Okay, interesting. Harsha, tell me a little bit about asset allocation, diversification. Now, generally there is a trend, again, young professionals, we're working very hard. We put in 12, 14 hour days. At the end of the day, you just want to go home and rest. You might not have time to, look at your investments so much. So just a couple of points, how can they go about getting a good diversification, a good asset allocation?
Well, the first thing when you begin, you need to, as we've already spoken about asset allocation, we've spoken about risk profiling. You understand, you consult a professional who could help you, decide what is your risk profile and how much would you put into equities, how much into debt, how much into precious metals, how much into real estate. Okay, so the first thing is you identify that class, asset class, and a percentage allocation to that particular asset class. I'll give you an example. Thumb rules, though we don't believe very aggressively into thumb rules, but just for the sake of a general audience, whatever is your age, that much money goes into debt. So if you are 30 years of age, 30% of your investable surplus should go into debt. Okay, now within debt, what products do you use? There are FDs, there are debt mutual funds, there are bonds, all those fit under debt segment. Now you have equities. We spoke about equities, a very hot topic at all times. All people who even do not invest into equities track the stock markets. Okay, so what about equities? You have options to invest directly into equities. You have an option, if you do not understand, you do not have the time to research on individual companies, you choose the mutual fund route. Mutual funds will have different kind of schemes with different themes, different objectives. You can choose the kind of objective that fits into your risk profile and invest into it. If you do not understand anything at all and you want to participate in the growth of the economy, and you want to participate in the equity markets, Nifty is one example. You invest into a Nifty, you get a basket of 50 stocks to start with, and if it's easy to track as well. Every day at the end of the day, I mean, you can just simply look at what the Nifty has performed and you will know whether your fund has gone up or gone down.
More of that on NSE FINWIZ, powered by CNBC TV 18. Don't go anywhere, we're going for a short break. Stay tuned. This is NSE FINWIZ, powered by CNBC TV 18. All the financial advice continues right here. Feroz, I want to talk to you about, again, when we read the papers, and again, even if you're not actively following the markets or any of the other, but the papers nowadays are talking a lot about inflation rate and the rupee slide and all of that. How important is that for a layman person who's not involved with the financial markets on a day-to-day basis, but is worried about his portfolio, his kitty to not be at least devalued? It should be growing up rather than going down. How important are these macro factors for them?
See, when you look at the macro factors, they are important just from an academic perspective. Why? Because every bad news is a good news to somebody. And especially when you're doing a systematic investment plan, due to, let's assume, inflation being high, bond prices go down because 10-year GSEC went up. All this you will read in the newspapers, but they are irrelevant because if you've actually invested in an SIP mode, your next investment will be bought at a better price. Because you're investing on a monthly basis, if there's a bad news, you know that the next installment is going to be buying you more units. On the contrary, if you hear a good news on the newspapers, you know that the installments which are already there, which have been bought, will do well. So because you are doing a systematic investment plan, you've nullified the impact of actually the market timing, right? So you don't have to be too worried.
Harsh, you're talking about the importance of having a financial planner, but how does one go about getting a good financial planner, not so that you don't make these mistakes of investing incorrectly or misinvesting?
Approach a financial planner, conduct a meeting with him without any commitment. The idea is all financial planners have their own individual flavors. So you may, while he may be a genius, you may not set, your mindsets and your wavelengths may not match. So you need to conduct meetings with a couple of people to identify the person who meets with your wavelength. Once you do that, you need to be honest in disclosing all your data. The suggestions, the advice that you will get will depend exactly on the data that you have given.
Feroz, I want to talk to you about insurance. Now, insurance is a subject that everybody, like, especially at the year end when we say that, okay, we have to invest so that we get a tax break and all of that. But that's not the right way to deal with insurance. And of course, nobody wants to think about the fact that they will die one day. How do you, I mean, you deal with people on a daily basis. How do you kind of sidestep this myth or this mental block?
Yes. Actually, you're right in pointing out that people generally think about insurance which has some tax breaks, and that generally happens between February and March, and this has historically been happening. But I think it's very important to view insurance as a risk management tool. everybody has risks. Risk is one thing which is manageable but unavoidable. You have to remember this statement, which is very critical. You cannot avoid risk. There is no way you can avoid risk, but you can manage it. So managing risk is very critical. So if you're getting a salary which is going to get credited to you every month, there is usage to that salary, right? So you need to make sure that there is a replacement theory. If you are not there, God forbid, that salary should still continue to keep getting credited to your account, so that your dependents are not dependent on your physical presence. You cannot expect your dependents to go through an actual loss of you not being there, we not being there, and also having a financial trouble. It's a double whammy for the relatives. So it's very important, because it's very difficult to cope with both at once. So how do you assess what is the insurance cover you need? It's very important.
Harsh, I want to ask you about monitoring portfolio, which is really important. Again, okay, so you have, let's assume you have a financial planner, so you're going to him or her and you're talking regularly. But it's important to do some research on our own to monitor it also while doing it with the financial planner. I mean, at home, sitting on a Sunday, I should be going over my portfolio regularly, right? Or how often should that happen?
Well, there are two sides to this. On one end, you are a professional in your own field. There is specific domain knowledge that you have for your own area of functioning. At the same time, there is another person who's a professional in financial matters. So you consult him the way we are not professionals and we do not have knowledge in medical field. So we go and consult a doctor who tells us what to do, and we follow that advice.
Yeah.
So with respects to monitoring your portfolio, yes, put in an attempt, put in an effort to try and understand. So there is a difference between putting an effort to understand and doing something on your own. Put in an effort to understand what is happening, bounce that idea off with your financial planner, assess whether it is suitable to you, and then execute. Do not self-medicate.
This is NSE FINWIZ powered by CNBC TV 18. After the short break, the audience asks us some important questions of our experts. Stay tuned. Welcome back. You're watching NSE FINWIZ powered by CNBC TV 18. It's now time for our audience to ask their questions of the experts.
I have one question related to the investment which you have discussed right now. Like you have discussed about the systematic investment plan and the mutual funds and everything. But what is your view on the real estate, investment in the real estate for our age group of 25 to 30 years age group? What do you think, whether we should go ahead in the investment in the real estate, or we should think about the investment after 35 years or something in the range of 35 to 40 years?
Before you get to this real estate decision, you have to go back, step back, and think of what is your asset allocation, right? Real estate actually in India has been one asset class which everybody likes, like that theory that real estate and gold never go down. That's very popular. So, but it's very important to see what portion of your assets are going to be in real estate. Like already mentioned, that you should never get married or like an asset beyond something you should. You should never get an emotional attachment to that. So if it is 30-40%, that's the maximum. You can skew your total net worth to real estate.
For a person fresh off the boat like me, of my age, what are the portals from where we can get basic financial knowledge? Like most of us have a technical degree or some other degree. So what are the basic portals, so that in medical terms I don't or we don't end up being a victim to a quack?
There are basically 4 fundamentals of financial planning. Okay. The first is living too short. Okay, that's where we're talking about insurance. You're working, suddenly, unfortunately, something happens, and your family is deprived of that, financially deprived of the income that you were generating. So that's living too short. So once you've identified that, you start working into how do I address that particular issue, which is life insurance. So now you know where to focus. The other issue is living too long. Okay, we've lived short, so this created problem. Now living too long. If we live beyond our earning years and way beyond beyond our means, then that's a problem. So now how do you take care of that, which is investments? So now you know that, okay, I need to address this particular issue where I need to specifically look for investments. So you'll find, I may not be able to give you names and of 10 websites that you can do that, but I'm sure you're educated enough to just search across and address that particular need.
I want to know one thing, whether we should go for commodity market, because the commodity market also is a hot cake nowadays. So in the systematic plan, we should go for commodity market, or we should go for equity or debt.
You should have an allocation into gold, silver, or any other precious metals restricted to about 10% of your portfolio. Because gold historically has been a hedge against inflation. You would see a return in gold in line with inflation. It will not help you create wealth in that sense of that you surplus, you have a large corpus at the end of the period. So the allocation to gold should be 10%. The rest can be divided between real estate, equities and debt.
Thank you so much, Feroz. Thank you so much, Harshvardhan. Thank you so much for having us here. Well, those were the enthusiastic employees at Welspun Energy's Noida office. We'll catch you next week with another set of India's young workforce. Till then, from the entire team, thank you for watching.